So, how much of Buffett's magic can data actually explain? What if you could break down his legendary track record using nothing but spreadsheets, a few online datasets, and some nerdy math? In part 1 of this video series, we used the Fama French 3-factor model and uncovered some surprising results. It's a similar kind of analysis used by researchers at the hedge fund AQR Capital to unpack Buffett's edge. And in this video, part 2, we'll expand our model to test whether factors like profitability, momentum, investment, or volatility help explain his returns. Then in part 3, we'll compare our complete results to AQR's. Let's recap what we know so far. Buffett's portfolio has a strong tilt toward large cap and value stocks. Even after controlling for market, size, and value, Buffett's portfolio still showed about 0.58% per month in unexplained returns, or nearly 7% per year. That's huge. This residual return, or alpha, was statistically significant, with a t-statistic greater than 2. Not bad for a 90-year-old investor with a flip phone. Let's add something new to the discussion. The p-value, or probability value, tells us how likely it is that a result this extreme could happen if the true coefficient were 0. Lower p-values mean stronger evidence. Roughly speaking, confidence equals 1 minus the p-value. So, Buffett's alpha, with a p-value of 1.24%, is, at a minimum, statistically significant at the 95% confidence threshold, about as close to certainty as you'll get, short of death and taxes. What happens when we expand the factor model beyond just market, size, and value? These 3 factors are referred to as the core Fama French model. They were later expanded to include profitability and investment, forming the 5-factor model. However, Fama and French themselves are skeptical of certain other variables, the most obvious of which is price momentum, and exclude them from their formal model. But is that a mistake in Buffett's case? Let's find out. To identify which factors actually matter when explaining Buffett's track record, we'll use a method called stepwise regression. Here's how it works. We begin with the baseline Fama French 3-factor model. Then we test whether adding one new factor at a time, investment, profitability, and momentum, improves explanatory power. But we don't just care if the factor is statistically significant. We also look at whether it reduces the alpha and improves the R-squared. That's what tells us if it helps explain Buffett's returns. Next, we test extended factors that aren't part of the traditional Fama French framework, like volatility and industry tilts, to see if they help crack the Buffett code. This process helps us isolate the variables with true explanatory power. We also check whether each factor has a real-world economic rationale. Finally, we revisit Buffett's alpha using only those factors that earned their place. Think of it like the Survivor TV show. Only the strongest factors survive. And just a reminder, if you're enjoying this breakdown, hit that subscribe button to follow along. Our first core factor that we examine here is investment, which captures the return spread between companies that invest conservatively versus those that expand aggressively. CMA stands for conservative minus aggressive. It is calculated based on the firm's past asset growth. Firms with low asset growth exhibit more conservative investment policies and tend to outperform firms with high asset growth. The p-value is 0.77 and the t-stat is near 0, so the investment factor adds no statistical power. Investment in this context may be useful for others, but for Buffett, it's a non-factor, literally. And just to double check, the 95% confidence interval includes 0 within its range, which means we can't confidently say Buffett's exposure to this factor is different from 0. Another reason to leave it out. Bottom line, we exclude investment from the final model and proceed with our testing of the other factors. Next, we looked at profitability, which captures the return spread between companies with strong versus weak operating profitability. RMW stands for robust minus weak. Profitability is measured as operating profit divided by book equity. Companies with robust profitability consistently earn higher returns than those with weak profitability. Here, the coefficient is statistically significant, with a t-stat well over 2 and a p-value under 1%. That gives us roughly 99% confidence that Buffett is tilted toward high-profit companies. Next, we examine the change in the alpha numbers between the baseline 3-factor model versus the tested model with profitability included. Since we see that both the coefficient and the t-stat of the alpha had declined, that means inclusion of the profitability factor does a better job of explaining away Buffett's returns. The adjusted R-squared increases only slightly, but as long as it doesn't decline, that isn't a concern. Finally, It makes intuitive and economic sense that Buffett would favor companies with strong operating profits. We check all the boxes, and profitability survives the stepwise regression to earn its spot in the model. And as far as the core Fama French framework using their five-factor model is concerned, this is our end result. We determined that Buffett is significantly exposed to profitability as well as large caps and value, and his residual alpha still clocks in at a robust 5% per year. While its t-stat fell just short of the threshold value of 2, it's still meaningful, since its statistical confidence is just barely below the 95% level. We could stop here. But let's examine the extended factor universe. Because what if there are other hidden dimensions that the traditional model doesn't capture? Let's see if those can explain even more. To kick off our extended testing, we'll start with momentum, which measures the tendency of recent winning stocks to continue outperforming and past losers to continue underperforming over the short to medium term. WML stands for winners minus losers. It is based on each stock's performance over the prior 12 months. Even though price momentum is widely acknowledged as one of the strongest anomalies, Fama and French themselves exclude this factor from their preferred model. Momentum is like the uber-popular kid in high school who never made it into a good college. Why? Because momentum is not well explained by risk-based economic theory, and it often overlaps with other signals, leading to instability in regression models. And that's one reason why momentum may appear useful in some models, but drop out once other factors are included. In our case, Buffett's exposure to momentum is not statistically significant. The t-stat is under 1, and the p-value is over 0.3. So we exclude momentum from the model as well. Let's now talk about the other extended factors. We tested many of these ideas, but won't deluge you with every regression output. We grouped them here into 3 main sets from the Fama French data library. Short-term and long-term reversal reflect the tendency for prices to revert over the past 1 month and 3 years, respectively. Industry portfolios test whether Buffett's performance could be explained by overweights to specific sectors, like tech, healthcare, or consumer staples. Variance and residual variance capture different types of risk. Variance measures total volatility. Residual variance, also known as idiosyncratic volatility, captures the stock-specific risk not explained by market movements. Each was tested individually using our stepwise process. Most didn't make the cut, but a few stood out, notably residual variance and 2 of the industry portfolios, which added clear explanatory value. Let's take a closer look at which extended factors actually made the cut and how they reshaped our final model. As noted, residual variance captures the price movements of a stock that are idiosyncratic, meaning unrelated to broad market risk. Buffett avoids stocks with high idiosyncratic volatility. Consumer non-durables are companies that produce essential goods like food, beverages, and household products, sectors where demand tends to remain stable regardless of the business cycle. The other group, retail and apparel shops, includes companies that sell goods such as clothing, footwear, and accessories. Buffett favors these 2 industry groups. So what got pushed aside? Profitability and size, victims of multicollinearity. Residual variance was highly correlated with profitability. Firms with strong, stable profits tend to have lower idiosyncratic risk, so the signals overlapped. When both were included, only one remained statistically significant, and that was residual variance. The same happened with size. Small cap stocks often come with greater idiosyncratic risk. Once that was already accounted for, size was no longer helpful, so it dropped out too. This chart shows the final regression result accounting for both the core and extended factors, market, value, residual variance, consumer non-durables, and apparel and retail shops. These 5 factors in aggregate explain Buffett's returns with reasonable statistical strength. The new alpha, 0.17% per month, or about 2% annually. We've come a long way from the nearly 10% annualized outperformance of Buffett's returns over the S&P 500, and yet there's some alpha left. But here's the big catch. The t-stat is now only 0.7. That falls far short of the threshold for 95% confidence, and the p-value is clearly way above the standard 5% threshold. So, what does this all mean? We can no longer be statistically confident that Buffett has alpha after controlling for these explanatory factors. However, that doesn't mean we're confident the alpha is 0 either. A t-stat of 0.72 is low, but the alpha coefficient, about 2% annualized, is still economically meaningful. The issue is the standard error is too large relative to that estimate, making the results statistically weak. In other words, there's too much uncertainty for definitive conclusions. Based on the p-value, we're just 53% confident the alpha is real, and that's not good enough by conventional statistical standards. And an important caveat to mention, the extended model used 14 additional factors that go beyond the official Fama French framework. While a few helped explain returns, the economic logic for many is less clear and may reflect data mining more than true explanatory power. So we interpret these results with appropriate caution. In future videos, we'll turn our attention to one of the most influential academic papers ever written about Buffett's strategy by an investment firm known as AQR Capital Management. They came up with an innovative approach to explain Buffett beyond regression testing, so you won't want to miss that. We'll also explore two big follow-up questions, and they're both worth sticking around for. First, could you approximate Buffett's strategy using a smart mix of today's ETFs and factor funds? And second, did Buffett's performance stay consistent across market cycles, or did his edge evolve over time? If you missed our first Buffett video, click here to catch up on how we built the foundation for this analysis. Or if you're curious how Wall Street's quant funds rank stocks, that video is right here. And as always, don't forget to like and subscribe, whether you found this helpful, entertaining, or just want to spread the word.